There is something sitting in your bank account right now. HMRC may have the legal right to access information about it, and most people over 66 have absolutely no idea this rule exists. This is not about tax fraud. This is not about filing your return late. This is not about a complicated financial scheme. This is about a quiet rule that has been in the background of the UK banking system for years, and in 2026, it is being applied more actively than ever before. The people most at risk are not wealthy pensioners. The people most at risk are ordinary retirees living on their state pension. People with a small private pension and a little savings interest. People who have done nothing wrong. People who simply did not know this rule existed. Your bank never sent you a letter about it. The DWP never mentioned it. HMRC never put it on the front page of their website. So today we are going to explain it clearly, calmly, and step by step, because understanding this now could save you from a very serious financial shock. Stay with us until the end. The solution we cover at the close of this video is the part most people miss entirely. HMRC has been given significantly expanded data gathering powers in recent years. UK banks and building societies now share detailed financial information with HMRC regularly. This includes information about interest earned on your savings accounts. If your savings account paid you any interest during the tax year, your bank reports that to HMRC automatically. You do not need to tell them. The bank does it on your behalf. Now here is where many pensioners run into serious trouble. Most retirees know about their personal allowance, the £12,570 income threshold before tax kicks in. But there is something called the personal savings allowance. And this is the piece of the puzzle that causes the most confusion. Basic rate taxpayers can receive up to £1,000 of savings interest per year completely free of tax. Higher rate taxpayers get only £500. Additional rate taxpayers receive no savings allowance at all. In years when savings rates were near zero, those limits were more than enough. But interest rates rose sharply over the past few years. Many savings accounts in 2025 and 2026 are still paying between 3 and 5% per year. That means a pensioner with £25,000 to £30,000 in savings could easily be earning over £1,000 in interest. And the moment your savings interest crosses that threshold, you may owe income tax on the excess, even if your overall income is still quite low. This is the rule that most pensioners never see coming, and this is the banking mechanism that gives HMRC the information they need to act. Let us be very clear about what this rule actually is. The real issue is not what most people think. We are not talking about HMRC freezing your bank account without warning. That is an extreme measure reserved for serious and proven tax debts after a lengthy process. What we are talking about is something far more common and in some ways more quietly disruptive. UK banks report interest payments to HMRC every single year. HMRC then compares that information against the tax records they already hold for you. If HMRC believes you owe income tax on savings interest, they will either contact you directly or adjust your tax code. If you receive a private pension paid through the PAYE system, HMRC can change your tax code without your permission. That changed tax code means your pension provider deducts more tax from your monthly payments. For a pensioner expecting a certain amount each month, suddenly receiving less can be genuinely distressing. Most pensioners never realize this is what has happened. They notice their pension payment has dropped and do not understand why. And the important detail comes later, because the numbers can catch people entirely off guard. Margaret lives on her full new state pension of just under £11,500 per year. She also receives a small private pension of around £2,000 per year. Her total income is well below the £12,570 personal allowance. She has never paid income tax and has never filled in a tax return. She has £35,000 in a fixed-rate savings account earning 4.2% interest. That works out to around £1,470 per year in interest. Because her income is below the personal allowance, she may actually be entitled to full protection under the savings starter rate band. This could mean she owes no tax at all on her savings interest. But Margaret does not know this. Her bank has already reported the interest to HMRC. HMRC has sent her a letter saying she owes tax on the amount above £1,000. The letter is confusing and Margaret is worried. In fact, she may owe nothing once her full situation is properly assessed. But without understanding the rules, she simply does not know that. Derek receives the state pension and a workplace pension totaling around £18,000 a year. He is a basic rate taxpayer. Over the years, he has built up around £28,000 in savings. With current interest rates, his account paid him £1,180 in interest last year. That is £180 above his £1,000 personal savings allowance. He owes income tax on £180, which at 20% means a tax bill of just £36. But because he never declared it, HMRC adjusts his pension tax code to recover it over the following year. He notices his monthly pension payment has dropped slightly. He does not understand why. He is not sure what to do. The amount involved is tiny, but the confusion and concern it causes is very real. Brian is 73 and holds £80,000 in savings across several accounts, all in his own name. At current rates, he is earning approximately £3,500 per year in interest. As a basic rate taxpayer, he has a £1,000 allowance, meaning £2,500 of that interest is taxable. His tax bill on that could be around £500 per year. Some of those savings originally came from Patricia's inheritance. Patricia has a lower income and a much smaller tax liability. Had the savings been held jointly or in Patricia's name, the tax position could have been significantly more favorable. This is where many retired couples get caught out. The way savings are organized between partners can make a very significant difference to how much tax is owed overall. Raymond only recently started receiving his state pension. During his working life, he had a side business and submitted self-assessment tax returns. When he retired, he assumed he no longer needed to. His savings interest for the year was £1,400. HMRC determined he owed tax on a portion of it. Because Raymond had no income taxed through PAYE, HMRC issued him with a simple assessment letter. This is a relatively new system where HMRC calculates what they believe you owe and sends you a bill directly. Raymond had never heard of a simple assessment. He thought it might be a scam. He ignored the first letter. The second letter included a penalty warning. Elaine's daughter has been helping her move savings around to get better rates. Over the past 12 months, Elaine has had money in 3 different banks. Each bank reported the interest separately to HMRC. Elaine received a total of £1,300 in interest across those accounts. No single bank's statement showed a concerning amount. The largest was around £700. So Elaine did not think there was an issue, but HMRC combined all 3 figures and determined her total savings interest exceeded her allowance. Because Elaine's only income is her state pension, she may actually have been entitled to pay no tax at all. But without knowing her rights, she did not challenge HMRC's initial letter. HMRC has become increasingly systematic about collecting underpaid tax on savings interest. In 2026, that process is more efficient than it has ever been. Under the Common Reporting Standard, UK banks report interest paid on savings accounts, current accounts, fixed-rate bonds, and notice accounts to HMRC as a matter of course. This reporting happens automatically. Your bank does not need your permission. you are not notified that it has occurred. HMRC then uses this data to build a picture of your total income. Where that picture suggests a tax liability, they act on it. The simple assessment system allows HMRC to send you a bill based on information they already hold. You then have a fixed window, typically 60 days, to either pay the amount or challenge it if you believe it is wrong. If you do not respond, HMRC may begin charging interest and late payment penalties on the outstanding amount. This is not a dramatic seizure of funds, but it can become a growing financial problem for pensioners who do not know how to respond. The first step is to calculate your total savings interest for the current tax year. Add up interest from every savings account, every fixed-rate bond, every current account that pays interest. If you have money spread across multiple banks, include all of them. HMRC will be combining those figures even if you do not. The second step is to understand which allowances apply to your situation. If your total income is below the £12,570 personal allowance, you may be entitled to use the savings starter rate band of up to £5,000 at 0%. This can mean pensioners with lower overall incomes can receive significantly more interest without paying tax. It is important to check your specific situation carefully. If you are unsure, contacting HMRC directly or speaking to a tax advisor is always a sensible step. The third step is to check that your tax code is correct. If you receive income through PAYE, such as a private pension, log into your personal tax account on the government website to view your current code. If your tax code has been changed without explanation, contact HMRC and ask them why. They are required to explain it to you. The fourth step is to consider the structure of your savings if you are in a couple. Each person has their own personal savings allowance. Splitting savings more evenly between partners where practical can reduce the overall tax exposure of the household. Rules around this can be complex, so it may be worth taking professional guidance. The fifth step is to make use of cash ISAs wherever possible. Interest earned inside a cash ISA does not count towards your personal savings allowance. Each tax year, you can deposit up to £20,000 into ISA products. Moving savings into a cash ISA over time can significantly reduce your future tax exposure. If you have already received a letter from HMRC about savings interest, do not panic. Read the letter carefully and note any reference numbers or deadlines mentioned. HMRC will tell you what they believe you owe and why. If the figure looks wrong to you, you have the right to challenge it. If you believe HMRC has made an error, write to them or call them to explain your situation. You may need to provide evidence of your income, including your state pension letter and private pension statements. If the debt is real but you are struggling to pay it, contact HMRC before the deadline. In many cases, HMRC will agree to a payment plan that spreads the amount over several months. They are generally more willing to work with people who come forward and engage. If you feel confused or overwhelmed, free help is available. The charity TaxAid offers free advice to people on lower incomes who have tax problems. Citizens Advice can help you understand your rights and draft correspondence with HMRC. Age UK's advice line is an excellent starting point for pensioners who need guidance. The worst thing you can do is ignore the letters. The underlying issue does not go away. But in most cases, once someone understands the situation and gets advice, it is far more manageable than it first appeared. The central lesson of everything covered today is this. In an era when interest rates have risen meaningfully, the savings many pensioners have built over their lifetimes can now generate enough interest to cross important tax thresholds. HMRC receives that information directly from your bank, automatically, every single year. Most pensioners never realize this is happening. They never realize their bank is reporting their interest to HMRC. They never realized their modest savings pot could now be generating a tax liability they did not anticipate. And they never realized that there are often legitimate allowances and reliefs that, once understood and applied correctly, could significantly reduce or even eliminate that liability entirely. The banking rule that enables HMRC to receive and act on this information is not going away. If anything, the data flows between financial institutions and HMRC are going to become more detailed as digital tax systems continue to develop. The best protection any pensioner has is knowledge. Understanding the rules, understanding your own numbers, and taking steps to structure your savings sensibly. Check your total savings interest for this tax year. Compare it against the allowances that apply to your specific situation. If you are not sure whether you owe anything, find out now rather than hoping for the best. A small amount of attention now is far less disruptive than a letter from HMRC arriving unexpectedly. If you found this video helpful, please consider subscribing to the channel. Here at Retirement Money UK, we cover topics like this regularly: state pension updates, DWP benefit changes, HMRC guidance for pensioners, pension credit, savings, and everything that affects retirement finances in the UK. Everything we cover is aimed at making these subjects as clear and as accessible as possible for people in or approaching retirement. Thank you for watching, and we will see you in the next video.